Hi there! In today's world, governments often support some businesses in order to make certain activities, acquire some assets, etc. So in today's video, we'll take a look at how to account for government grants under IFRS, because when a government provides a grant, it gives some benefit or advantage to the company in comparison with companies without grants, and this must be carefully treated in your accounting. I'm Sylvia of IFRS Box, and I help people understand and simplify IFRS. I have created the IFRS Kit, a complex IFRS course for you, plus lots of free IFRS materials, so you're welcome to check them out at ifrsbox.com. In order to account for government grants correctly, we need to look at standard IAS 20, accounting for government grants and disclosure of government assistance. It's a very old standard, effective from 1984, with no significant changes afterwards. Its main objective is to prescribe the accounting for and disclosure of government grants. These are all kinds of resources transferred to an entity, whether it's a cash or some non-monetary assets, and usually an entity must fulfill certain conditions in order to receive the grant from the government. And also government assistance, and this is not a transfer of resources, but some other action of government to provide some benefit, for example, free marketing advices, helplines, etc. IAS 20 deals with almost all types of government grants, except for various tax reliefs, such as tax holidays or tax breaks, grants provided for agricultural assets under IAS 41, government acting as a part owner of an entity, and grants in the financial statements reflecting the effects of changing prices. In this video, we will not deal with the exact conditions for recognizing grants, but I want to illustrate the specific accounting treatment with the example. So how to account for a government grant. Before I tell you more, remember this: never ever account for a grant directly in equity. IFRS simply do not permit so-called capital approach, but they rather prescribe the income approach. So sooner or later, you need to recognize the grant in profit or loss. There are two basic types of grants: grant related to the acquisition of assets and grant obtained for the reimbursement of certain expenditures or costs. Let's firstly explain the accounting for grants for the acquisition of assets. Here there's a choice. The first option is to account for a grant as for deferred income. In this case, when a company receives the grant, the journal entry is to debit cash or bank account and credit deferred income. And then you need to recognize the grant in profit or loss. You would do it on some systematic basis over the life of the asset acquired. The journal entry is to debit deferred income and credit profit or loss. The second option is to account for a grant as a deduction from the carrying amount of acquired asset, property, plant, and equipment in this case. When you receive the grant, you debit bank account or cash and credit property, plant, and equipment or asset account. Here you do not need to take care about amortizing deferred income in profit or loss, because everything is reflected in a depreciation charge. With regard to grant related to expenditures, we need to differentiate whether the grant is to cover some past costs or current or future costs. If the grant was provided to cover past costs incurred, it is recognized immediately as income in profit or loss, so the entry would be to debit cash and credit profit or loss. If the grant is provided for the current or future costs, then it is recognized in the period when the costs are incurred, recognized, and here again there's a choice. Either you recognize the income from grant as other income, or you deduct it from the expenses. So these are the basics, and let's solve some simple example. ABC receives the following government grants in 20X2, and here we have 3 different grants described. Let's not read it now in details because we will solve one by one in a second. Prepare the journal entries in the year ended 31st December 20X2. So let's read the first case. Number 1, grant of 40,000 currency units to acquire a water cleaning station. The cost of the station was 100,000 currency units and its useful life is 8 years. ABC acquired the station on 1st July 20X2 and recognized depreciation on a straight line monthly basis. So this is a typical grant related to the acquisition of assets. And as I have told you earlier, you have an accounting choice here. You can treat it either as a deferred income or as a deduction from the cost of property, plant, and equipment. In this video, we'll treat it as deferred income, but if you'd like to see the second option, please visit ifrsbox.com and you will see the solution in our free article. So when ABC receives the grant and if all other recognition criteria is met, then the journal entry is to debit cash or bank account with 40,000 currency units and credit deferred income with the same amount. Well, the shortcut SOFP means the statement of financial position or the balance sheet, just to make it clear. Then how the grant is recognized in profit or loss in 20X2. As said before, it should match the expenses, depreciation in this case. Well, we can see that ABC acquired the station on 1st July 20X2, and let's assume that it started to use the station on the same date, and that's 6 months in 20X2. The grant amount is 40,000 currency units, and the useful life is 8 years. So we can calculate the amount in profit or loss for 20X2 as 6/12 times grant of 40,000 divided by 8 years, which is 2,500. We debit deferred income with 2,500 and credit profit or loss, income from government grant with the same amount. Let's take a look at grant number 2. Grant of 10,000 currency units to cover the expenses for ecological measures during 20X2 to 20X5. ABC assumes to spend 3,000 currency units in 20X2 to 20X4, I guess that's in each of these years, and 2,000 currency units in 20X5, that's 14,000 currency units in total. So this is the grant related to current and future costs. The receipt of the grant is recognized as debit cash or bank account, 10,000 currency units, and credit deferred income with the same amount. Then we need to match the income from grant with the expenses that the grant covers. So how do we do it? Well, IAS 20 doesn't say anything about the precise allocation of grant income, whether you should do it proportionally or on a straight line basis or how else. So in this example, let's take the proportionate approach, which is acceptable. We know that in 20X2, ABC spends 3,000 currency units. Total estimated expenditures are 14,000 currency units, so we can calculate the proportion as 3,000 divided by 14,000 times the grant amount of 10,000 currency units. As a result, in 20X2, we debit deferred income with 2,143 currency units and credit profit or loss, income from government grant with the same amount. Well, we can also credit the related expense account. That's also acceptable. Let's jump to grant number 3. Grant of 3,000 currency units to cover the expenses for ecological measures made by ABC in 20X0 to 20X1. Well, this one is easy because it's a grant related to past costs, and in this case, we can recognize the receipt of the grant immediately in profit or loss. Our journal entry is therefore debit cash with 3,000 currency units and credit profit or loss, some income from government grant with the same amount. So we have just explained the basic accounting for government grants under IFRS, and if you'd like to learn a bit more, you're welcome to check ifrsbox.com, subscribe to our free newsletter, and receive many useful IFRS articles, videos, and other materials. Bye-bye, and thank you for watching.